we're in a box that we can't get out of now. We have no choice but to maintain easy money basically forever. But that comes at the cost of increasing leverage forever until everything blows up. The game ends when people figure out that that's what's going on and start acting accordingly by dumping the currency, buying real stuff, and sending the prices of things up. I think we can see that in 2016. We're really close to it now.
The most significant results encountered for this Canadian mining region in over a decade. With a Canadian Mining Hall of Fame legend at the helm for more discoveries statistically than 1,000 geologists combined, this is the one hard asset stock to research right now. Learn more at crushthestreet.com/hardassets.
Hello everyone and welcome into crushthestreet.com. I'm here with John Rubino of dollarcollapse.com. He's an author, he's an analyst, he's an investment advisor. He's a great guy and I'm fortunate to be able to interview him today. John, thanks for joining me.
Good to talk to you again, Kenneth.
John, I was looking at an article today and Goldman Sachs is saying that they are admitting that America's corporate balance sheets are greatly levered, and there's a huge crisis on these balance sheets with leverage at its highest point in a decade. Higher interest rates at this point seem like the obvious answer when it comes to what the Fed wants to do, but to slow this trend down, are we damned if we do or damned if we don't?
Well, that's the problem when you borrow too much money. You reach a point where there is no good solution because any way that you can see to get yourself out from under all this debt involves a lot of pain. Same thing for corporations as for individuals and families and countries. You know, we've kind of across the board in the developed world borrowed way too much money. And so there's nothing ideological or mystical, magical, or anything about this. It's just common sense. You know, when you borrow too much, your life spins out of control. And so we're seeing that in various parts of the world play out right now. And the U.S. corporate sector is kind of the latecomer to this party because it's only been in the last few years that they started borrowing huge amounts of money at really low rates and using the proceeds to buy back their stock. And this masked a deterioration in the top line for a lot of companies. You know, their sales are going down in the last few years, especially in the U.S., but they're able to keep their earnings per share at a respectable level by buying back stock and then dividing their shrinking earnings into a smaller base of equity out there. And so that allowed them to fool the investment community for a while. Now people are starting to catch on to it. The stocks of the biggest share repurchasers are starting to underperform the rest of the market. And what that means is that investors are starting to look at the balance sheet as well as the top line number and bottom line number and say, oh, okay, well, these guys, their earnings per share is holding up pretty well, but their debt is going through the roof. In other words, they're leveraging themselves to the hilt in order to maintain the illusion of health. And so now their shares are starting to underperform. And that's usually the end of the cycle for something like this. When something that you've been doing to fool your customers or your investors stops working, then you have to stop doing it, right? And so companies will have to, in the future, buy back a lot fewer shares. Yeah. And that'll kick out a support from under the market and probably make it harder for us to continue this bull market in 2016.
Now, off the top of your head, I mean, are there situations where this low interest rate environment is going to be beneficial? And to give you an example for what I'm thinking is mining companies right now that have the money or have access to money are able to go out and purchase other mining companies for pennies on the dollar, purchasing value at ultra low rates. Is this a situation that is beneficial for these companies and other companies out there that are able to truly take advantage of this situation in this low interest rate environment?
Well, at the bottom of a cycle, that is something you want to look for, is the solid company that has really good access to capital or a lot of cash on its balance sheet, who can then go in and buy up weaker competitors at really good prices and position itself to just roar into the next bull market. And so in precious metals, it's primarily the the streaming companies, the royalty companies who are in this position, like Franco-Nevada and Royal Gold and Silver Wheaton, who have either lots of cash or really good solid credit lines at nice low interest rates that they can use to give a call to a struggling exploration company that has found this great deposit, but that can't get the capital to bring the deposit online. And they can say, look, we'll finance your next couple of years if you give us 10% of your mine's output for the next 10 years at an extremely low price. And so these little companies who otherwise would go out of business have no choice but to take that deal. And so they lock in what turns out to be a great deal for the streaming company as the market recovers and prices go back up. And so you're seeing the streaming companies cut these really big deals out there right now with a lot of different people on extremely favorable terms. So yeah, an environment of low interest rates and really weak commodity prices can be very favorable for the remaining strong companies in the industry. And it's true in other industries. I don't necessarily pay attention to a lot of other ones where there are roll-ups going on. But that's the kind of thing that happens at the bottom of the market, and it's the kind of thing that you should look at when you're at that part of the cycle. In a lot of other industries, we're at actually the top of the market. So you're seeing the opposite, where the companies that have leveraged themselves to the hilt are really starting to suffer. And so I think next year there could be kind of a two-tiered market in a way, where the industries that just cratered in the last couple of years, which is primarily natural resources and raw materials, stabilize at their bottom because they've reached the point where prices of a lot of things are at or below the cost of production, which means a lot of production is going to be taken off the market. A lot of mines are going to close and factories will shut down. And this will lower the supply, which will bring things back into balance eventually. Oil has fallen, for instance, from $110 a barrel to 40-something a barrel. And it may not be at its bottom right now, but it's not going to go to zero. So the bottom is within sight somewhere, whether it's 30-something or 20-something. We're not that far in terms of dollars right now from what will eventually be the bottom, and then you'll see the industry stabilize down there with the survivors looking much better on the way up. We're seeing a lot of cycles play out asynchronously, so one is at the top while one is at the bottom, and you want to pay attention to that and shift from the one that's topping out to the one that's bottoming.
John, right now, according to this article I was looking at, it was pointed out that there's an enormous amount of goodwill being paid out for companies. There's a lot of mergers and acquisitions going on. And just for people who don't know, goodwill is a premium that is paid to another company when they're purchasing the company or taking it over. And Goldman estimates close to $1 trillion in goodwill has been added to the corporate balance sheet since 2008. And quite frankly, this could all be construed as fictitious premiums on balance sheets considering the environment. John, is this what a bubble looks like when it just kind of gets so exuberant that companies are out there just paying premium after premium after premium for companies expecting continued growth?
Yeah. At the top of a cycle, you get big companies wanting to build empires. They stop thinking about, is this going to position us really efficiently in the year ahead? And they start thinking about, if I buy that company, I'm the biggest in my industry. I am the top dog. And the egos of these CEOs run out of control because the government is giving them too much easy money. And easy money makes you crazy because it distorts the signals that your market normally sends to you about what to do and what not to do. If you can buy something with money that you only had to pay 1% a year for, then it almost doesn't matter in your mind what you have to pay for the company because you're getting this money so cheaply. You can't pass up the chance to borrow at 1% because during your adult lifetime, you've never seen that kind of cheap money before. And so it's hard not to borrow the money. And then once you borrowed it, you got to do something with it. So you buy somebody to make yourself the biggest, most powerful person in your industry. And so you see this race among all these suddenly egomaniacal CEOs who are drunk on easy money trying to build empires, and then it all falls apart. And these empire builders at the top of a cycle look like total idiots at the bottom of the cycle. But they're gone, of course. They take their past decades' bonuses and amble off into the sunset, rich and still prestigious. And they leave their successors with a mess to clean up. And you're seeing that everywhere. The big banks are a perfect example. They have grown bigger and bigger since the 2008, 2009 crisis, when they were already way too big. And now they're even bigger. And so at some point, the whole financial supermarket idea is going to be discredited. And the guys who built these monstrosities will be seen by history as misguided, at least, and corrupt at worst. And so, this is a normal process that goes on, but that is exacerbated by easy money. So the government is really enabling this kind of behavior by cutting interest rates to unrealistically low levels and pumping out huge amounts of cash via QE programs into the banking system. And then the banks have to do something with it, so they lend it to their corporate clients. And you get a mess that reverberates throughout the economy.
Yeah, the whole ego thing, it was actually something I haven't really considered as far as companies wanting to be at the top. And then I guess that plays with the investor's mindset. When they're buying the biggest and best company, they think, as far as the CEOs and the executives go, if they can be the biggest, then they can attract the most investors, and it continues to fuel this bubble fictitiously. So kind of interesting. Great point to bring up.
Kenneth, it is interesting because investors get sucked into this idea that, well, if we combine these two giant companies into one even bigger company and we cut out all the overlap, we'll get massive efficiencies. And then sell-side analysts on Wall Street run the numbers based on that fictitious assumption and get phenomenal earnings out there in the future. But none of it plays out. None of it works out that way because there are so many speed bumps along the way. It's very hard to merge two different cultures, and you really don't get the efficiencies you think you're going to because you become this big lumbering behemoth that really is just not nimble enough to compete with the little guys who are coming up and eating various parts of your lunch, and so these big companies inevitably fail and have to be broken up again. And we're just at the peak of the takeover mania. 5 years from now, we'll be at the peak of the breakup mania, and life will go on. This is just how it works.
So, John, we have a debt ceiling now that's raised to $19.6 trillion. Tons of different loans and debt. I mean, you got $1 trillion in car loans, $1.3 trillion in student loans, mortgage debt, consumer debt, et cetera, et cetera, et cetera. One interesting point that I actually saw in one of your articles was that the Fed owns a great amount of the U.S. debt. So this brings up the question, couldn't they just forgive some or all of the interest that is owed to them? And I want to get your answer, yes or no. And could you explain this funny money dynamic to me? And I guess a follow-up would just be, is this another dimension of stimulus that we haven't yet resorted to?
Well, you know what? The Fed already forgives the interest on the government bonds that it holds by rebating the income from it back to the Treasury. So to the extent that the Fed is buying the bonds that the U.S. government issues, we're just directly, in effect, we're directly monetizing our debt. We've just completely bypassed the bond market, in effect, and we're just creating money and throwing it out into the economy. So that's really the last stage in the destruction of a currency, historically, where the government just says, screw it. I'm just going to create this money. I'm going to spend it however I want, and that's that. And then the currency starts to collapse because people realize that that's what the government's doing. They don't want to hold the currency anymore. You get the Austrian economics crack-up boom, and that's the end of the game. Well, we're starting to do that now. So yeah, to the extent that the Fed is just going to rebate its interests back to the federal government, then it doesn't really matter how much debt we issue, as long as the Fed's going to buy it back. But At the same time, when you push down interest rates dramatically the way we have, you cause the whole world to leverage itself. So it's not just the US government that's at risk here. It's every other government, of course, but the corporate sector and the consumer sector. You know, the biggest growth sectors for debt in the US right now are student loans and car loans. So we have once again convinced the private sector to take on huge amounts of debt in order to pump up the economy and in that way set the stage for a big crisis in the future that'll begin in the private sector and then spread to the government sector. So there's really no way out of this. And if interest rates go up, we have something called that I call a variable rate world, where everybody else's interest rate goes up in line with these base rates that you build indexes off of. And so your credit card payments go up, and your adjustable rate mortgage goes up, and your prime rate business loan goes up. So you take money out of all of these parts of the private sector when you raise interest rates at the Fed funds level or the government bond level. And so interest rates going up is like a massive tax increase on the whole world. And that's why we can't do it anymore, because we borrowed so much money that we can't handle a tax increase. So if we try to raise interest rates going forward, we'll find out very shortly that it slows down the economy and cancels out whatever benefits the current government policy is hoping to create. And so we're in a box that we can't get out of now. We have no choice but to maintain easy money basically forever, but that comes at the cost of increasing leverage forever until everything blows up. So we're at probably the late innings now in this game, and the game ends when people figure out that that's what's going on and start acting accordingly by dumping the currency, buying real stuff, and sending the prices of things up, you know, and that'll destabilize the system. So I think we can see that in 2016. We're really close to it now.
John, many people are saying that we're moving towards a third world country style where the rich are getting richer and the middle class is getting crushed. Can you explain the dynamic of what exactly or how the system is benefiting the rich and what is working out for them? And maybe we'll talk about the other side of the equation afterwards.
Yeah, the corporate buyback thing that we talked about before is a really good example of how this works. The government lowers interest rates and creates a lot of new currency, tosses it into the banking system, and the banks give that money to their preferred customers before the increase in supply lowers the value of the currency. So the preferred customers and the big banks get all the benefit from this new currency. And this tends to pump up asset prices. In other words, you give rich people money and they've already eaten all they need to eat today, and they've already got a nice house and everything. So they go out and they buy fine art, and they put the money in blue chip equities or government bonds or whatever. And that pushes up the price of financial assets, which makes them richer. But it doesn't help the regular people who don't have very many stocks and certainly don't own a lot of fine art or anything. So they just kind of trudge along making about the same money that they made the year before and the year before that and the year before that, which is actually shrinking in real terms because you have to adjust it for inflation. And so they get a little poorer. And so the gap between rich and poor grows and grows and grows in an environment of easy money. And that's what we're seeing now. And the end comes when the financial markets get so unstable because of all the leverage that that they start to tank. And that lowers the value of all these assets that the rich people have bought. But very probably by that time, the rich people will have cashed out of their financial assets and real assets. And you see that happening right now. You know, London penthouses are through the roof because you can't make more London penthouses. And probably in the not too distant future, you'll see money flowing back into things like energy assets because they're cheap now, and you can't make more oil wells. And same thing with precious metals. In cycles like this in the past, a lot of money has flown or flowed from financial assets into real forms of labor. Because while the government can create as much fiat currency as it wants to, it can't create more gold and silver. And so the relative supplies of those things tend to favor gold and silver. And so we'll see that happening too. But in the meantime, the average person is really disadvantaged by this. And the average member of the 1% is really favored. And also the political class. You know, if you're proposing policies that help your rich constituents, they're going to turn around and help you get reelected. So you've got really a system now where the Fed, the big banks, major corporations, and the political class are all in effect part of one organization. They're different divisions in an organization whose goal is to increase its own power. And it's doing so at the expense of everybody else. So this is, in a lot of ways, like an aristocracy that we've created now. People who don't have to live by the same rules as everybody else, and who have the ability to manipulate the system in order to continue to get richer and more powerful. So again, it continues until it breaks, and it will break pretty soon because it always does. But while it's going on, it's tough for almost everybody and paradise for just a few.
Well, let's give some hope to maybe some of us who haven't been dealt the cards of some of these rich people who are in bed with the government, and just people who just have a lot of money in general. What is it that people can do to help themselves and to not be crushed by the system and not just fall by the wayside? You know, are there things that people can do to help themselves get out of this, you know, decreasing lifestyle, this standard of living that's getting sucked out of the American dream?
Yeah. Well, you can't go out and buy a Renoir or a Van Gogh, and you can't go buy a London penthouse. But what you can do is buy some gold and silver coins, for instance. That's one of the assets that will go up when this phase change really gets going in the financial markets. And so that's a relatively safe place to put your money to hide out for a while. It'll maintain its purchasing power over long periods of time, and that should help. Another thing you want to do is pay off debt. You know, they want you to go into debt. They want you to rack up credit card bills and buy the biggest house possible for the biggest mortgage possible and buy a brand new car every 3 years with borrowed money. So you should do the opposite. Drive a used car and maintain it well. Live in a small house that you can pay for or come close to paying for. Pay off your credit cards and cut those things up and throw them away. You don't need a credit card. Just have a bank account with as much money as you need this month and use a debit card to pay your bills. And in that way, you disconnect yourself from the con that's being run on you right now. So you have to live a little smaller than some of your neighbors maybe, but you gain peace of mind, the ability to sleep at night, knowing that your finances aren't at risk the way most people's finances are. And at work, you need to recognize that in the volatility that's coming, a lot of jobs are going to be at risk. So to the extent that you can make yourself indispensable by not just showing up and doing your job, but figuring out what the people around you need, especially your bosses, and developing the skills to meet those needs and being willing to take on extra work and help people out, you up the odds that you'll be one of the ones left standing when there's a round of layoffs, as there inevitably will be, unless you're working for a good gold miner or something like that. So that's a list of things that you can do right now to improve the odds that you come through this in pretty good shape.
Well, everyone, that's invaluable advice right there. And thanks so much, John. Everyone, that's John Rubino of dollarcollapse.com. Make sure to visit his site. John, any interesting things coming up? Any interesting articles you have that you'd like to share with everyone before we say goodbye?
Yeah, I'm going to post one today on Portugal, Kenneth, which is kind of an obscure idea that most people don't ever think about. But Portugal is part of the Eurozone. It's had some financial troubles like a lot of the peripheral countries there have. And they just elected a far left-wing coalition that's going to take over the government, apparently, in the next couple of weeks. And that coalition is anti-Eurozone, and anti-austerity, of course. In other words, they don't want to cut government spending that goes to regular people anymore. And they want to increase government spending and try to help the people who've been hurt by the policies of the past few years. And if that happens, they're going to be at odds with the guys running the Eurozone. And we're going to see another big potential Eurozone crisis. Remember, Greece for the last few years has been front page news because if Greece defaulted on its debt and left the Eurozone, it would threaten the fabric of the Eurozone itself. The whole common currency concept might not work anymore. Well, Portugal's a bigger economy than Greece, though not huge. And it looks like it's heading in the same direction. So we're going to see a resurgence of Eurozone crisis talk here pretty soon. And it could easily affect the rest of the markets. One way it could affect the markets is by making the dollar even stronger because the euro goes down if we're worried about the future of the euro. And that's going to impact the ability of our companies to make money by slow our economy down and make it less likely that the Fed can raise interest rates and more likely that they'll have to cut interest rates next year. So it's a process that it's definitely worth paying attention to because it affects us directly in a lot of ways.
Yeah, I don't think people realize how globally we are dependent on these companies that are based in the U.S., how dependent on global sales that they are. So a strong dollar has been an interesting dynamic to see a lot of these companies deal with lower earnings over the last while now. Interesting stuff. The U.S. benefits from the stimulus. The Eurozone really doesn't have an option of that. They have a hard time being able to provide liquidity. The U.S. is really the only one that's able to still do that. Just real quick, your thoughts on what they're going to do and what they're going to be able to do to get through this and kick the can down the road a little more.
Oh, I think we'll double down on past policies. In other words, we've pushed interest rates all the way down to zero in a lot of the world and slightly negative in some parts of the world because that's what we do when there's a slowdown. We lower interest rates and they've gone down and down and down for 30 years now. So what we're going to do in 2016 is push them down even further. We're going to get negative interest rates around the world and to an extent in the U.S. too because we think we can raise rates, but I think we're going to find out that we really can't because the rest of the world is so slow right now. The rest of the world is dropping into a recession. Just a few quick stats. Greece is still broke and getting broker with all the Middle Eastern refugees that are flowing in. And China's imports fell by 16% last month. China's the second biggest economy. If they're buying 16% less this year than last year from around the world, that implies a slowdown for a lot of its trading partners. Portugal, as I said, is getting ready to throw the Eurozone into chaos. And the dollar is now back to its 12-month high, and there's $9 trillion of U.S.-denominated debt in the emerging markets out there that is now way underwater. So you're going to see a lot of blow-ups in Brazil and Thailand and places like that where there's a lot of dollar-denominated debt that they can't cover anymore. And so that's a time bomb waiting to blow up that the higher dollar could set off. And all of this stuff is going on at once, and it all implies a global slowdown. So when that is actually apparent to everybody, and when it hits the U.S., this whole, we're in a recovery thing is going to be shown to be an illusion because we can't be in a recovery if the whole rest of the world is in recession. And we will drop back into recession. And when that happens, all bets are off because financial assets are priced for perfection in the U.S., and government finances are already stretched, and individual finances are already stretched. So we're at risk of it becoming much more than just a garden variety recession in 2016.
Well, we'll be watching it. Really interesting stuff. And I don't know what they're going to do with the interest rates here in December. It doesn't seem like they can raise, but I know they're hinting at it. So,
well, they want to because it gives them ammunition to lower rates then later. They want to be prepared to be able to cut rates by 4 or 5 or 6 percentage points when the time comes, and they can't do that now. So they're terrified that they're going to be caught without the ability to really lower interest rates in the next downturn.
Everyone, that's John Rubino with DollarCollapse.com. Thanks, John, for coming on the show with me today.
Thanks, Kenneth.